Welcome to Drill On Earnings with the latest quarterly results from the Intel. This is the business story behind one stock and a move. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. Intel's been in a world of hurt for a long time. This quarter is no different. Q4, of course, Wall Street wants a beat or a miss. Okay, it was both. It was a beat and a miss. The revenues were a little better than expected. The earnings were less than what some expected. But let's look at the business here and understand what's really going on. So revenues were down 7% year over year. So maybe they were better than estimates, but the estimates were for a crummy return, and that's what they got. 7% decline in revenues. Not great for Intel. As I said, a business that's struggling so much, $14.3 billion to be exact. And fourth quarter earnings per share was a loss of 3 cents, as I mentioned here. They forecasted the next quarter's revenue is going to be only $11.7 billion. And so not high expectations here. Now, when we dig a little bit deeper, the number we used to look at back in the old days, could Intel keep margins above 50%? In the last quarter, they were like 12%. So 39% is better, but in the contextual history of Intel, 39%, not great. And as a result, the company's conserving cash. And one of the ways they're doing it, and maybe it's worrisome over time, is they're spending less money on R&D, and not just less dollars, because that's true, but they're also spending less as a percentage of revenues. Intel has spent as much as 35% of revenues on R&D to get them ready for the future. That's down to 27% right now, necessary cuts perhaps for a business that's struggling. What is that business? PC is still a big part of it. Client computing, 43% of revenues. And that business is actually doing okay. Data center, 18% of revenues, not doing so great lately. And foundry really matters here. So much of the story is about the tens of billions of dollars that now former CEO Pat Gelsinger directed the company into building these great big factories for semiconductors. Just aren't working. They aren't working. They aren't even operating in a lot of cases yet. They're not completed, but they're also not really bringing in the significant revenues from other companies. They hope to create kind of a competitor, maybe a domestic competitor to Taiwan Semiconductor. It's just not working. Now, the numbers weren't a lot worse. Maybe that's why the stock was up 3%. It's also true that the stock is down 56% in the last year. Horrible loss for this once great company. And their interim co-CEOs are warming seats there. They're doing a search for an external search for a CEO. They don't have anybody yet. And so this is kind of just kicking the can down the road. When you look at the different segments of the business, you can see where the real problem is. Nothing's doing great except for client computing, pretty nice profits, but the foundry business is losing a lot of money, over $2 billion. And fixing that cost structure is a problem for these guys. One that their CFO and now one of the co-CEOs, acting co-CEOs, Dave Zissner, talked about on the conference call.
We are improving the cost structure of the foundry business as part of our overall spending reduction plan. So that will also help. And then just keep in mind, these wafers that we're producing at Intel 3 and 18A have much better cost structure and margin structure, relative to the price structure than their predecessors. And that will be beneficial on the foundry side. So in the caveman macro sense, I think the best thing to do is probably take this like somewhere in the 40 to 60% fall through, and that's probably the right rough order math to get you to where the margins will go in any quarter based on what you're projecting the revenue to be in that quarter.
So someday 40 to 60% margins, wouldn't that be nice? There's no evidence of that in these numbers right here. And maybe a new CEO can get them there. Maybe these acting CEOs can get them there. They sure aren't there yet. All right, so what's it all mean? What's your big drill on earnings takeaway? What's the thing, you go out and someone says, what happened to Intel? Well, here's your summary. Q4 earnings for Intel, the company had about $14 billion in revenues, but that was still 7% less than last year. And the numbers just weren't great. 14.3 billion is the exact number, but that's not our bite, the one number that tells us a whole lot. The one number that tells you a whole lot about Intel's earnings is a negative number, negative $2.26 billion. That's how much Intel lost on its foundry business in just 13 weeks in the fourth quarter. That's really bad. Intel's got to fix that problem. All right, thanks for listening to Drill Down Earnings. I'm Cory Johnson. Check us out on X at Cory TV and on all the socials at Drill Down Pod, TikTok, Instagram, and on YouTube.